If you're looking to unlock larger loan amounts and secure competitive interest rates, then this video is for you. Secured debt and unsecured debt are two distinct types of borrowing. Secured debt requires the borrower to provide an asset as collateral, such as a house, a car, or home equity. On the other hand, unsecured debt doesn't require any collateral. It includes personal loans, credit cards, and store cards. When a debt is secured, it means that the lender can repossess and sell the asset used as collateral if the borrower fails to make payments as agreed. However, it's important to note that not paying back an unsecured debt can also lead to repossession of valuables and assets. Compared to unsecured personal loans and credit cards, securing a loan may be somewhat easier. Using an asset as collateral mitigates lending risk and makes lenders more comfortable. However, affordability tests and credit history checks are still conducted. Secured loans generally offer lower interest rates compared to unsecured debt, although it's not guaranteed. The interest rate offered depends on personal finances and credit history. Someone with an excellent credit score could obtain a better interest rate with unsecured credit compared to someone with bad credit using a secured loan. The most common assets used to secure a debt are property and vehicles. Other assets can be used, but it's less common. It's important to remember that when an asset is used as collateral, it can still be used by the individual, such as living in your home or using your car. If you fail to pay back a secured loan, the lender will contact you and ask for immediate payment. Ignoring the notifications will lead to a default being registered on your credit report, making it harder to obtain credit in the future. If future defaults occur, the lender may initiate the repossession process. The repossessed asset is then sold and the proceeds are used to pay off the debt. If there's a shortfall, the debtor may still be responsible for paying it, which could even lead to filing for bankruptcy. Secured debt offers access to larger loan amounts and competitive interest rates, which can be beneficial for purposes like home renovations. However, there are risks involved, such as the asset being at risk of repossession. Additionally, appraisal fees and additional costs may be associated with secured debt. Taking out secured debt can be a good idea if you're seeking a larger loan amount or a lower interest rate. However, it's crucial to fully understand the risks involved and explore other credit options. Seeking advice from a loan broker or financial advisor can provide clarity based on your personal aims and circumstances. It's still possible to secure a loan with bad credit. By using an asset as collateral, lenders may be more willing to lend to you, although you may have to pay higher interest rates. Some lenders even advertise secured loans specifically for individuals with unsatisfactory credit scores. Secured debts can only be written off if the lender agrees to it, which is highly unlikely since they can recover the debt by seizing and selling the collateral. Instead of seeking debt write-off, negotiating a new repayment structure or exploring suitable debt solutions are recommended. A car loan can refer to a loan secured with a vehicle or car financing, which involves paying off a new car over time through monthly payments. Car financing is a type of secured debt because the loan is secured by the car and can be repossessed if payments are not met. Throughout this guide, we have mentioned secured loans, but there are various types available. Some use specific assets as collateral, while others may be used for specific purposes. Home improvement loans, debt consolidation loans, and home equity loans are examples of secured loans, each with its own characteristics. Most secured loans provide a lump sum that is repaid over a fixed period through monthly payments. Some secured loans, like home equity lines of credit, are provided over a draw period. It's essential to research each type of secured loan individually to understand how they work. If you're struggling with debt, then debt consolidation could enable you to make a single monthly payment, possibly with lower interest rates than your current debt. However, there are a number of debt solution options available here in the UK. Some are free to use and others include fees, and each will have their own pros and cons. If you want to learn more about the solutions available, then we've created a really great form that you might be interested in checking out. Click the link in the description below to get started and answer a few multiple choice questions like the total amount of your debt, how many people you owe, and your living situation, and we'll connect you with one of our trusted partners so that you can find out more and take steps towards improving your financial situation.